Hello, it's Binni here. Today I'm going to talk about trading into Singapore Index Futures. Just to give you a brief introduction what Singapore Index Futures is about. The short form that we use to call is SiMSCI. Alright, so the long form is SMSCI Singapore Free Index. So with with the short form, it is easier for us to know it, and we call it SiMSCI, SiMSCI, SiMSCI. Alright, so a few things that I'm going to talk about in this session here. Number one is what is Singapore Index Futures and how you can use it to hedge if you have a portfolio of Singapore stocks, especially if you own banks for dividends, and then how you can use it to hedge in case that these banks corrected. Alright, and you don't want to give up your bank shares, then you can use the SiMSCI to hedge. And then again, briefly on how you can tap into SiMSCI trading, what you can do. Alright, and lastly, just to have a background information, I'm also teaching trading on Singapore Index Futures, SiMSCI, together with a course with SGXAcademy. And this course is up to 90%. Okay, I repeat, 90% subsidized by IBF, Institute of Banking and Finance of Singapore. Alright, this means, for example, if the cost is 1,800, right, then with a 90% subsidies, you pay $180. Alright, so let's get to what is SiMSCI. Okay, so left hand side, I have this part here which shows STI constituents. So these are the STI component stocks, right? Right hand side would be SiMSCI. Okay, so SiMSCI, there are today about 20 securities as of March 25th. Okay, so all the component stocks, right, in SiMSCI except two. Okay, which are the two? One is SEA, so this is the company which is the mother company of Shopee, and the other one is Grab. So these two companies are listed in the US exchange. The rest of them are listed in the Singapore exchange. Right, so those which are highlighted in yellow, that's in the STI constituents, they belong to the SiMSCI. Okay, what is the implication here? It means that the SiMSCI movement is actually quite highly correlated to the movement of STI. Now, when we have this high correlation, right, it is useful for us to help us, hedge into our existing stocks. Because if you take a look at the top four, okay, minus away SEA, the top four, alright, stands for about near to 50% of the weightage in SiMSCI. Okay, DBS having 20%, and then OCBC about 13%, UOB about 11%, near to 12%, and then Singapore Telecoms about 6.8%. Alright, now with this, if you own a basket of bank stocks plus, Singtel, then you can be using SiMSCI as a hedge to your existing portfolio. Now, what is a hedge then? A hedge means that when, let's say, you own the bank stocks and the banks have a bit of correction, so instead of selling away your bank stocks, you could go short the SiMSCI, so that when the index or the SiMSCI drop and the bank drop as well, then you can make money from the sell side without giving up your bank shares. Alright, now if you take a look at exactly what is SiMSCI, then it is an index futures which is by the exchange. Now, why is it important that you want to trade into an instrument by the exchange? Number one is eliminates counterparty risks. Okay, meaning that, in any case, if the other party, which is the counterparty that you are trading, has any issue, then there's a high chance that you're going to land up with a total loss. Okay, and second thing, of course, right, it's to enhance liquidity. Because if you look at the SiMSCI contract, it's mostly traded by professional traders, and those traders belonging to houses and funds, right? Because then when this traders or funds, they need to hedge or they need to tap into more liquid instruments, then the first choice is to trade into the futures contract. Alright, therefore, being exchange traded has an added benefit for versus those which the other instruments that's more common will be contract for difference, which is CFDs. Okay, when you are trading CFDs, your counterparty is the individual company, the broker itself. Alright, so the CFDs, although it has its advantage, but in terms of the comparison between the counterparty risk, then I would prefer one that's with the exchange. All right, and of course, then SiMSCI is a leverage instrument, right? Meaning that you don't need to come up with the full amount of money to trade in the SiMSCI, right? The average contract value per contract is about 30,000+ Sing dollar. All right. However, to start trading the SiMSCI, you need about 5% off as a margin. So what's margin? Margin means that is a deposit that is required for you to park it with the futures broker in order for you to get started. All right, take note that when you are trading in the futures contract, there are two types of margin. One is the initial margin, which is the initial amount of deposit required for you to start a trade. Now, the second type of margin would be the overnight maintenance margin. All right, so this means that if you want to roll your trade overnight, then you need to make sure that you have enough money, which is the overnight margin, right, the maintenance margin in your account already. Okay, so to start off with trading SiMSCI, you need about 5%, and in this case here, if you assume that a contract amount, the full amount is about 30,000+, then the average margin that's required is about 1,600. In the past 2 years, I've not seen the margin requirement for SiMSCI to exceed 1,600. I think that we would seriously, safely think that it's about 1,600 to start off a one contract of SiMSCI. All right, so you don't need to have a lot of money. Let's say, for example, you are interested to tap into the movement of banks, but you don't want to pay for 30,000+ per 1,000 shares of DBS, then you can be looking to trade into the SiMSCI, and that's about 5% of the contract size, about 1,600. All right, of course, SiMSCI, our futures contract, is a very, very simple instrument. If you think that price is moving down, then you can go short. If you think that in the future price is going up, you can go long. So there's no complicated algorithm or calculation there. For example, volatility, implied volatility, or declining expiration yield. All right, don't have. Okay, so if you simply think that tomorrow, right, the index is probably going to hit down, then you just have to go short. That means you have to short the contract of SiMSCI. If you think that tomorrow is going to go up, then you have to buy a contract of SiMSCI. It's that easy. All right, so let's take a look at an example of this chart here, which is DBS, which I've extracted in 2022 during the period of February. So we know that DBS dropped, right, after it announced its earning. And from a high of around 37.50, it dropped all the way to about low of 31. So in terms of percentage move, that was a drop of 70% from the high. Okay, so that's quite substantial. However, in April, you're gonna receive dividends from DBS, and you think that this is just a short-term volatility. You do not want to give up the stocks. So what can you do then? You can short one contract of the SiMSCI to hedge into the movement of DBS. Okay, what do I mean by hedge? You foresee that DBS is going to hit down, but you own the stocks and you want to tap into this particular downward movement here. So let's say, for example, if you look at the movement of DBS, by dropping 17%, that was a negative $6.50. Okay, this means that if you sold DBS near to the high point here and you buy back here, then you will likely make a profit of $6,000 per 1,000 shares. However, as you know, we are not able to totally 100% predict the future. All right, so we do not know how far that DBS can go down. All right, so in order to do so, what we can do is we can, at the high point here, without selling the DBS shares, all right, we can short one contract of the SiMSCI. Okay, meaning that if SiMSCI is to drop, then you will again profit from this drop. If you buy back your short, which is to close your SiMSCI position, all right, you still have your DBS shares, which in fact later on we saw that DBS moved up from the low about 15%. So if you take a look at a long-term investors, you own the banks for income and dividend, all right, and overall you're bullish about Singapore banks, but yet there would be this periodical down move, all right, which you can't help it because that's the up and down move of a market. Then you can use the futures, okay, because the futures is a very straightforward product to hedge when price are correcting. Okay, so this is the use of SiMSCI when especially you own a basket of stocks that's very highly correlated to STI. Alright, then what's the benefit of using SiMSCI? As I explained, this is a chart of SiMSCI during the same duration when DBS had a drop. Now the SiMSCI also at the same time moved down. It moved down by approximately 18%. Now, the benefit would be you don't need to come up with the full amount of trading, buying one contract or selling one contract of SiMSCI. All right, because SiMSCI is a leverage instrument, and the margin required to tap into the movement of SiMSCI is about 1,600 Sing dollar, all right, per contract. Meaning that one contract you need 1,600, two contracts you need about 3,200. All right. Of course, then you have to pay for the brokerage fee and the trading fees as well. All right. But if you take a look at the movement of SiMSCI, it moved about 65 points. If you manage to tap into this full movement here, about 65 points, then every 1 point per contract is going to give you $100. All right. So if you are looking at a 65-point gains on one contract, then you will be making about $6,500 here. Now, the profit divided by margin, which is the amount that you need to come up with, right, is going to give you about 400% return. So this is a smart way of using money, all right, meaning that you do not need to come up with a full amount of money, all right, but at the same time, you're able to tap into the movement here, and you end up with about 600+% return. Now, of course, then with any leverage products, the risk will be higher. So do understand what is a leverage products and do take note of your risks. All right. So one of the benefit of trading into the futures is it trades about 22 to 23 hours. All right. And this means that if you don't have time to trade that in the morning and afternoon because you're working, then you can come back home and you can trade that at night. All right, because remember I talked about that SiMSCI has two other component stocks, and that's SEA, which is listed in US market, and Grab as well. Okay, so they move very nicely. Now, one of the things I liked about SiMSCI is I like the fact that it trades during the public holiday. All right, I know that we need to have some rest, but for my method in terms of trading SiMSCI, it doesn't require a lot of time. All right, so this is just one example where I was trading with the IBF students. All right, the students who took my IBF course. Then overnight last year in 2021, there was a huge drop in the US market. All right, so today it's the same period. That's also the Good Friday holiday. Last week we had a huge drop in the US market, and yesterday is Good Friday. So the Singapore is having a public holiday, and then the STI is not trading. Okay, but yesterday the SiMSCI was trading, and we are able to tap into the movement as well. Okay, so for example, US had a huge drop, let's say the day before. However, you can't tap into the movement. Why is that so? Because then, the next day would be a Singapore public holiday. You can't do anything because then the exchange is not open, the stock market is not open at all. All right, but don't worry, if you have, let's say, a lot of Singapore stocks and you think that the overnight movement is going to affect into the movement of the Singapore stocks when it opens, all right, as soon as the trading day resume, then what you can do is you can use the SiMSCI to hedge into your position. That means to already sell the SiMSCI, to short the SiMSCI during the public holiday. All right, so this was what we did then. There was a huge drop in the US market, right? And then the next day we actually put in a trade, which if you are using stocks, you can't do that. But if you're trading in the futures, yes, you can do that. And we tap into that downward movement very, very nicely. Lastly, if you want to learn how to trade the SiMSCI and as well as a comprehensive course, all right, to trade into the Singapore stocks using technical analysis, you might want to join me at this course together with SGXAcademy. And it's a course under the IBF skills framework. All right, so under the IBF standards training scheme. And if you are Singaporeans and 40 years and above, then you'll be paying 10% of the course fee, which means that 90% will be paid by this skill framework funds. All right, so that's a privilege for Singaporeans. But if you are like, let's say, 40 years and below, 40 below 40 years old, then you pay $360. Okay, if you look at the course fee and the comprehensiveness of this course, and I think personally I would recommend that, because not because I'm the one training and supporting this course, but you know, that is a privilege that you want to be entitled for, you want to get it for, right? The support is also extensive, because I'm doing this course for about 2 years already, and I'm still giving my support for my intake number 1, and right now we are running intake number 8, and we will hope to continue with this course for as long as possible. So if you are interested in trading SiMSCI, and of course you are interested in trading into the wash and rinse method that I'm using, then do join me. All right, I will leave a link to the course so that you can, you know, feel free to browse around the course framework and the course content. All right, and one of the key things that we are highlighting in this course, especially the 8 live sessions, is that we are using the wash and rinse method. So wash and rinse method is a proprietary method by myself. It is used to trade into stocks, into forex, gold, cryptos, and as well into SiMSCI. Okay, you can use that into any futures trading. But let me just quickly illustrate using this SiMSCI chart on how and where we have traded recently. For example, we are able to trade into this portion here to sell into SiMSCI at around the price of this place here to tap into this downward movement. Okay, so that's a wash and rinse, right? The earlier trade that we were able to get was this WR here, which is the wash and rinse, and we're able to sell somewhere around here to tap into this downward movement. All right, it doesn't mean that we have trades only once a week or etc. We do have trades quite often, almost every day. All right, because we do you know, cascade our trade to trade in the lower time frame, and it's especially important to look into the lower time frame. And lower time frame is something that I will be trading, which is the concept of multiple time frame. All right, so I hope to see you in the course, and if you like to about this video, all right, about trading in SiMSCI, do let me know. All right, and do subscribe to my video, because I will be talking about different instruments, especially instruments that I'm trading.